So how do you calculate your gains and losses, right? So let me just walk you through an example. Let's say, earlier the New Zealand dollar example, let's say, let's make it euro dollar, right? That's the most common currency, 1.2001. Okay, let's say this is the price that you buy. You went long, L. And this is the price that you sold at, right? You sold at 1.2005. Okay, so it's a price, call it S, right? Sell. This is long. So what is your gain on this trade? Well, you can tell that you have actually earned 4 pips, right? You can tell, right? You earn 4 pips. Can't even spell it, right? You earn 4 pips, right? Because you take 1.2005 minus 1.2001. That's a difference of 4 pips. But how much do you make on this trade, right? Is dependent on your Forex lot size. Are you trading a standard lot? Are you trading a mini lot or a micro lot? So a standard lot, right, is 100,000 units. Right, so generally, a standard lot 100,000 units, right? Each pip, right, is $10 per pip. Now, one thing to bear in mind is that depending on the currency that you're trading, depending on the currency that your account is funded, right, this figure over here will change over time. Okay, so you might need to check with your broker what is the value of 1 pip to you for one standard lot. So let's say you are funded with a USD account and you're trading euro dollar. So it will be $10 per pip. So if you make 4 pips just now, you saw, right? You made 4 pips, right? Okay, let me I'm a little bit okay, 4 pips. This is understandable. 4 pips, right? So what you'll do is you take 4 multiplied by 10. So that is a gain of $40 for you on that trade. Right? You take the number of pips that you have earned or lost, right? Multiply by this how many dollar per pip that you're trading, right? This value over here is dependent on your Forex lot size. If you're trading, so let's say 10,000 units, right? It will be $1 per pip, thereabout. Okay? So this is how you calculate your gains and loss in Forex. So moving on, right? The different types of Forex orders, right? So there are a few types, right? Market order, limit order, stop order, stop loss order. So let's talk about market order. So market order is an order, right, that tells your broker that, hey, I want to enter the market right now. I'm the boss. I want to enter right now. So the pros, right, of this approach is that you know for sure that you will be in the trade. The broker will, execute the trade for you at whatever is the market's prevailing price. The downside to this is that you're actually paying a premium. Sometimes the market is moving fast, it breaks out, it's going up, and if you hit a market order, you're paying a premium. Okay, so that is the pros and cons, right, of market order. Limit order, right, on the other hand, is you enter only if the market comes to your desired price level. Let's say Apple shares, right, it's trading at $120. You think that it's too high. I don't want to pay $120 for Apple shares. What you can do is use a buy limit order, all right, and put it at, let's say, $100. So this means that if Apple shares comes down to $100, only then will you get filled on the trade. So the pros of this approach is that you're typically, right, entering at a cheaper price, right? You let the market come to your price level. The downside of this approach is that you might miss the move because Apple might not come back to $100. It might go up to 150, 200, and hey, you missed the boat, man. And the other downside is that you're actually trading against the current momentum, because if you think about this, right, as the market fill you on the trade, you're actually trading against that down move against you, right? So that might be something that you want to be aware of as well. What about stop order, right? So a stop order is typically used, right, when you want to trade a breakout, when the market is moving in your favor, then you hop on and get on board the trade. So it's like, let's say Apple shares right now is $120, and you notice that this price, right, of Apple shares has not break above $130 over the last 2 years, right? So you want to trade the breakout on Apple because you might believe that, hey, if Apple hits $130, there's a good chance it could be at 140, 150 in a few weeks' time. So what you do is you can place a buy stop order on Apple shares at $130, right? So you only enter the trade if the price hits $130 and above. So this is what we call a buy stop order. The pros of this approach is that you're entering your trades, right, with momentum, because the market, right, the market has your back, right? Wind is at your back, right? So this is why you only enter when there is momentum in your favor. The downside to this is that this might be a false breakout, right? So what's a false breakout is actually say the market, right, over here, it breaks out and then it does a reversal and goes back into the range. So this is what we call a false breakout. All right, so that might be possible, right, if you are using a stop order. And stop loss order, right, is pretty much an order, right, to exit your trade if it goes against you. It's somewhat like a insurance, right, to protect yourself, to protect your account if the trade goes against you. So let's say again, for example, Apple shares, you buy at $100, okay, and you have a stop loss order at $90. So what this means, right, is that if the market, if the price comes to $90, you will exit the trade. All right, so this is what we mean by using a stop loss order. All right, so the beauty of this is that you're actually cutting your losses, you're limiting the damage that could be done to your trading account. The cons of this is that often, right, if you, I wouldn't say often, right, depending how you set your stop loss, right, but there's a very possible likelihood, right, that the market could hit your stop loss, right, and then reverse back in your initial direction. And then you might say, man, why did I use a stop loss? I'm so silly. Now I'm out of the trade and the market has went back in my favor. So yeah, you're going to get that quite a number of times in your trading journey, right? It's part and parcel of trading. So you want to embrace this fact, right? So this could jolly well happen. And if you think about this, this is worth it, right? Because what if the price doesn't go back into your intended direction? What if it drops to like $5, right? You have pretty much, wipe out a huge chunk of your capital. So stop loss order is like paying an insurance, right? It's like to give you a comfort of mind to know that you are protected no matter what happens, right? But sometimes, right, I would say that stop loss, right, is like paying insurance, right? It sucks, right, to pay insurance, but when the shit hits the fan, right, you're glad that you have your stop loss there to protect you, right? So that's the message that I want to bring across. Okay, so now the different types of forex chart, right? So generally there are many types of forex chart, but I'm just going to share with you the three common ones: the line chart, bar chart, and the candlestick chart. So if you look at this one over here, right, let's look at line chart first. Line chart, typically it's a line on your chart, right? So it only shows you, what it does is that it connects the closing prices of the chart. Okay, you can choose it, right? Whether you want to choose the close, the open, high, whatever. But by default, it usually connects the closing prices on the chart, and it shows in the form as a line on this on the chart. It's very useful to identify the direction of the trend if you're not sure what is the trend. Okay, so that is a line chart. Moving on, right, we have what we call a bar chart. So a bar chart looks slightly different. Okay, so I'm just going to share with you how to interpret it. So let's talk about the green one you see over here. The green one typically means something like that, right? Goes up. Okay. Okay, so this is a green color bar chart. So what this means, right, is that the open price, right, or rather the closing price is above the open. So this is why it's bullish, right? The market has closed higher for the day. So this over here, this line that you see over here on the left is open. Okay, this one over here is the close. And this is the high of the day, and this is the low of the day. This is the low of the day. All right, so if you're looking at a daily time frame, this is what it means. If you're looking at a 1 hour time frame, then this is the high of the 1 hour time frame. This is the low over the last 1 hour. Okay, and if you're looking at weekly time frame, this is the high of the week, then this will be the low of the week. Okay, the low of the week. All right, so this is the again open, and this is the close. Now, what if you see a red color bar? What does it mean? Well, it's just the opposite actually. So getting the tools, okay. So if you see a red color bar, so what this means, right, is that again, right, if you are looking at the daily time frame, this is the high of the day, low of the day. This is the open, and this is the close. This should be quite common sense because this is a bearish bar because the price has closed lower for the day. All right, it has closed below the open. So the close has to be below the open. So the open is on top, the close is below, right? So this is how you read a bar chart. And for candlestick chart, okay, let's have a look, right? Same thing. The concept is the same. For green color bar, okay, let's say green color bar. This is the high of the day, the low of the day. Let's call it LH. So for it to be green, for it to be bullish, right, where must the open be? Well, the open must be below the close, right? So this over here is the open. And this over here is the close. Make sense? So now what about the red color bar that you see? So the red color bar is just the opposite. The red color bar like this. Right here. So again, this is the high of the day, low of the day. H. No, this is the low. And this is the high. And where is the open? On the top or the bottom? Well, if you recall, right, for the bar to be bearish, right, the open has to be on top. Right, open. And this is the close. Price close lower for the day. Okay, does it make sense? Then let's move on. So now that you know how to read the different types of Forex chart,